Trust in a market is not built by letting companies enter with celebration and exit with secrets. The delisting of MerryMart from the Philippine Stock Exchange shows why the rules of disclosure are more than legal rituals. They are the foundation of every investor's confidence. It began with a promise. The exchange dreams of blockbuster listings, new champions like Mynt that can bring life to a market in desperate need of depth and liquidity. But in the shadows, a different drama played out. MerryMart announced its plans to leave just as minority shareholders faced a crucial decision. Should they sell at the offered price or hold on, knowing the company would soon vanish from the board? The core issue is clarity. As shareholders weighed Double Dragon's tender offer, covering billions of shares at a precise 0.48 pesos, the most critical audited document was missing: MerryMart's 2025 annual financial statements. Extensions were filed, commitments were made, yet, as the tender period closed, the latest full-year results remained out of reach. This gap was not a minor paperwork delay. It was the gap between informed consent and blind surrender. Financially, the warning signs multiplied. MerryMart's Q1 2026 numbers revealed flat revenues, rising costs, shrinking profits, deepening debt, and evaporating cash. Sales barely moved, operating expenses rose, and operating income fell sharply. Even the small net profit belonged mostly to other interests, not the parent company's shareholders. Most troubling, operating cash flow remained negative, and liquidity was tight, a retailer's red flag. For a market built on trust and transparency, this context made the absence of audited financials impossible to ignore. Every major valuation exercise rests on these documents, not to satisfy bureaucracy, but to test assumptions, uncover risks, and verify assets. Quarterly reports can hint at trends, but only audited statements tell the whole story. This is not just MerryMart's problem. When delisting mechanisms move forward without full recent disclosure, the rules protect process, not people. And that erodes confidence for everyone, not just those caught in a single transaction. What should change? Regulators and the exchange must require up-to-date audited financials before any delisting vote or tender offer. Extensions must be specific, explaining delays, not simply deferring them. And fairness opinions, while helpful, must never stand in for audited facts. Investors must not be left to choose between selling in the dark or being trapped after the doors close. If the exchange wants to attract the next Mynt, it must show the courage to protect trust at every stage, entry and exit alike. The market cannot be a one-way street, open and bright when money flows in, but dim and narrow when shareholders need transparency most. Reform is not anti-business. It is pro-market. Only through strict, substantive disclosure can Philippine markets earn sustained public confidence. When the last exit is as clear as the first entrance, the promise of the public market is truly kept.